Hello everyone, this is Sebastian McMahon from IA Financial Group, and I'm back with the weekly review for the week ending February 9, 2024. Looking at the markets this week, again negative for bonds, slightly positive overall for equities, although in Canada we had a small pullback on the week. S&P 500 should be hitting 5,000 likely today. At least we hit it intraday, we didn't close there, but today maybe that will be the day. So let's see when you get this review at the end of the day. Right now it's prior to market open. It's pointing in that direction, but as you can see again, NASDAQ, S&P 500 are leading the way. MSCI Emerging having a good week. Is the bottom in for the China stock index? We still don't know, but at least we're starting to see something that could look like a bottoming pattern, and the Chinese administration, of course, is trying to prop up the stock market. So interesting rebound on the week there. Oil up 5% on the week, so strong week here. Canadian dollar up, gold down. Prepare your S&P 5000 hats. We might be hitting that today. Just looking at the chart over the last 10 years, as you can see, the momentum recently has been pretty strong. Sentiment remains very strong, and but interestingly, when you look at the stock market and you see this pattern here for the total index, it's interesting to see or to note that in 2023, more than 70% of the stocks listed on the S&P 500 underperformed the index. So it's clearly led by, the Magnificent Seven, things that we've mentioned in the past, big tech, which is having a big weight, AI craze, which was an important factor for the stock market in 2023, continues to be that in 2024. And people are asking the question, are we looking at maybe some potential over late 1990s redux on the stock market with the AI team leading the way? Well, the answer to that is that the jury's still out. It's hard to know, but if you look at 1998, and why 1998? Well, if you look at the next chart here, as you can see on the left, these are the recent returns for the S&P 500 and the Russell 2000, so small caps. And the S&P 500, as you can see, starting in 2021, strong performance, then a bear market, and then a rebound, and we're out of a bear market, about to hit 5,000 for the first time, as I mentioned. If you look at the pink line here, that's the Russell 2000, so small caps, and small caps are still in a bear market. So there's a strong divergence between the two. And last time we saw such a divergence was in 1998, just before the dot-com bubble. And as you can see on the right, in 1998, starting from the moment where the divergence happened, 1 month, 3 months, 6 months, and 12 months after, you had still an outperformance from the S&P 500. So the momentum remained in favor of the large cap index. It's too early to say that we'll have something like that, but there's a risk that we have kind of a mania forming around tech and around AI. The big tech names are the ones that are making that have high profit margins, growing their earnings, have a strong weight in the index. If the global economy remains soft as we think, well, then usually growth stocks tend to do well, or the growth factor does well. When the Fed starts cutting and central banks start cutting, even though a lot of that is already priced into the market, maybe that could fuel even more interest for growth stocks, tech stocks. So you kind of see a potential for something like that to continue. So let's see where it is, but let's not discount the potential for more gains on big tech and AI, even though valuations are elevated. Sentiment is strong, momentum is strong, and there's some reasons to at least shy from being too pessimistic about anything related to big tech right now. So just to give some historical context here, looking more at the macro data, credit cycle. So we had the senior loan officer opinion survey in the US. That's the gray line on this chart, and it's inverted. We see that this is a very good leading indicator of total growth in bank lending. And again, always mention that credit is the lifeblood of the economy. Tightening credit standards means that there's less lending going on, and we see that the index, the leading index that we have from the bank tightening lending standards index here is pointing towards a tough first half of the year as monetary policy tightening continues to make its way into the economy. But interestingly, the second half of the year, it is starting to point up. So maybe there's going to be, again, some macro volatility in the short run, but there are some reasons for optimism on the macro front for the later part of 2024 based on what's going on with the credit cycle here. There is one risk factor that we cannot discount. Again, sounding like a broken record, but there might be again a rebound of inflation coming from the supply chain. And this is important because the supply chain is kind of exogenous to what's going on within the US economy. Mostly here's the shipping costs that are higher because of the situation in the Red Sea. That's a chart on the left. Tripling of the costs of shipping a container. Of course, containers hold lots of value. So even if the cost of shipping a container goes up by $2,000 or $3,000, divided by the value of what's in the container, that might not lead to strong inflationary pressures. But if all of this situation starts to put some sand in the gears of the global supply chain, then we could see inventories fall, and then we could see some more pricing power from suppliers. And this is what's on the right, the ISM manufacturing PMI, looking at the inventory component. We're starting to see inventories fall. So it's not yet something that's very material, but it's something that will have to be followed in 2024 if there are some issues with the supply chain. So again, not yet, but you can make up a scenario where we start to see that, and that could bring back inflationary pressures in the mix, and that could delay the decision from central banks to start cutting early in 2024, how many cuts they would do in 2024. So very important story to follow. Doesn't change the base case scenario yet, but it's a risk that's brewing. In Canada, we have a strong job creation in January. Unemployment and wage pressures are declining. That's a good news. We had 37,000 jobs. I would say that the report has kind of a low quality feel to it because it's mostly part-time, mostly services, mostly public employment also that is behind the growth in employment this month. We still see that the Canadian economy is not keeping up with population growth in terms of jobs creation. So there's that. The participation rate is down. The employment rate is down. The unemployment rate is down. So first time since December 2022 that we had a downtick on the Canadian unemployment figure. So there's good news here. Also on the good news, say on the right, the wage pressure, so average hourly wages for permanent workers down from 5.7% year over year to 5.3%, so in the right direction, but 5.3% remains still way too elevated for the comfort of the Bank of Canada. So there's nothing here to change the scenario that the bank will start cutting somewhere around the middle of the year and cut likely 2 to 4 times. But it's always good to see jobs being created. But the point here is that we're not following, not keeping up with the growth of the population. So again, this will remain an issue for the momentum that the Canadian economy is kind of lacking right now. So that's it for the jobs report. Next week, we'll have existing home sales, housing start, and manufacturing sales in Canada. In the US, we'll have CPI inflation, always an important number. Retail sales, housing, NAHB Housing Market Index, and the University of Michigan Sentiment Survey, which has been rebounding strongly recently. But the consensus forecast for the next number is that it will be flat. So let's see what comes out there. So it's always a pleasure to serve you. ia.ca/economy, iagam.ca/insights for all of the info that you need. Thank you, and I'll be back again next week.